Hello and thanks for joining us at interest.co.nz. I'm Jenee Tibshraeny and today I'm joined by the Secretary to the Treasury, Caralee McLeish. Thank you for your time, Caralee.
Kia ora.
It's been a crazy year in which both the government and the Reserve Bank have exercised enormous amounts of power to keep New Zealanders employed and to keep us safe. I'd just like to rewind to January 2020, before COVID really hit, and I guess before the Reserve Bank started using what we now know as unconventional monetary policy tools. So this is the quantitative easing and the funding for lending program. At the time, Treasury and the Reserve Bank wrote to the Finance Minister and warned that using these tools to lower interest rates would have significant trade-offs. You warned that these may increase wealth inequality by boosting asset prices, and concluded that the government might need to consider thinking about responding to the side effects of using these tools. Has the government, in your view, done enough to respond to the side effects of very loose monetary policy?
So it's clear that the pandemic has had very uneven impacts right across the economy, and in particular many vulnerable groups have been disproportionately impacted. Low-skilled workers, youth, women, and some ethnic groups, including especially Pacifica and to some extent Māori as well. There are many reasons for the differential impact, for the different distribution, and many different policies, including monetary policy, do have distributional effects. On top of that, there are many other factors more broadly that can lead to different outcomes in the economy. It is the case that monetary policy, whether it's alternative monetary policy or whether it's a conventional policy, does have distributional impacts. But those effects will be different depending on what tool is used and even the design of that tool. We know that lower interest rates will benefit borrowers and they will benefit asset holders. They will tend to benefit those at the edges of the labour market, but they make savers worse off and they make those who are seeking to own assets, it makes it harder for those who are seeking to own assets as well. So the net effect of all of those different factors is one that is complex, and it's ultimately an empirical question. It's not clear exactly how alternative monetary policy has flowed through to wealth distribution and to income distribution, and that's something that we're looking at more closely. But it is certainly the case that both monetary policy and fiscal policy need to work in a coordinated way, and what we have seen through the last year is that fiscal policy has been a way in which to target support to those who are most impacted.
Just want to go back to your comment about it still not yet being clear of the way that monetary policy has flowed through. Some would argue it is very clear when you look at the Reserve Bank's figures as to bank lending, and banks have lent up an absolute storm against property, whereas business lending hasn't. It's actually declined, and I guess the argument is that it might start to pick up once businesses feel better, once the economy recovers. But to date, do you accept that monetary stimulus has benefited homeowners and probably share owners as well?
Yes, so it is very clear that the reduction in rates has been one of the big driving forces behind higher property prices, and that has benefited those who already own homes, and it's made it much tougher for those who are seeking to own homes. So that's not in question. I guess the bigger question, though, is about how that flows through to overall wealth inequality, and that is where things are a little bit unclear. So we need to understand, to answer that question, we need to understand how housing wealth is distributed across households. And we do know that New Zealanders have an enormous amount of wealth in housing, so around 60%. And we know that those who are in the lowest wealth deciles tend to have less housing assets. But we don't know the full wealth distribution of housing, and until we really look at that sort of assessment, we can't tell the impact on overall wealth inequality. There's been a study done in the UK that showed a 10% rise in house prices led to less wealth inequality inequality because housing wealth was concentrated in the middle of the population.
Right.
And then also we need to consider other factors like the impacts on debt, the impacts on other assets and so forth. So that's why I say it's a complex picture to understand overall impacts on wealth inequality, and it's even more complex to understand what the impact would have been without alternative monetary policy and without other types of policy as well.
That is a good point. It's hard to know the counterfactual.
Exactly. Yeah.
But in terms of the advice that Treasury and the Reserve Bank gave in January, it did say that the government would need to think about mitigating some of the side effects of this. I'm just wondering if that advice was continued through the year or repeated throughout 2020, or whether Treasury changed tack and said actually that is no longer the case. The government might not need to step in to sort of soften some of the edges around what monetary policy is doing.
Yeah, so I think it's important to take a step back and look at the context in which that advice was given. It was very much about institutional arrangements for alternative monetary policy at a time when we thought alternative monetary policy was actually some way off. Clearly the situation has changed since then, but what we have seen is that both monetary and fiscal policy have been working in tandem to do some heavy lifting to support the economy. Monetary policy working through broad-based credit channels and also supporting lower debt costs. Fiscal policy working with more targeted mechanisms to make sure that those who are most affected by the pandemic are also provided support. So I think that what has happened over the last year is consistent with that advice. We also have established institutional arrangements to support better coordination between fiscal and monetary policy through indemnity frameworks, and we've been working very closely with the Reserve Bank right throughout the pandemic.
Okay, I'll just go on this issue one more time. For somebody looking at the housing market, just cannot get in, or with the rent going up, they might think, well, we knew this was going to happen when we really lowered interest rates. We knew that asset prices would go up, and even if we thought initially that they would fall, there was a major concern that that would happen. Ultimately, when you lower interest rates, asset prices go up. So why has the government not acted sooner to try to mitigate that sort of situation happening?
Yeah, I think pretty much all forecasters at the start of the pandemic thought that house prices and other asset prices would be falling, Treasury included, but many others as well. And so we have been surprised by the extent to which interest rates have driven up house prices, but there have been other factors as well. I mean, I guess I'd just go back to the fact that monetary and fiscal policy have been working together, and there's been an enormous historic amount of fiscal support to help those who are really affected by the pandemic.